From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for September 27th, 2024. Let's check the calendar. Your Milwaukee Brewers are wrapping up the season at home with a 3-game set against the Mets. Oktoberfest is going strong at a number of places like the Bavarian Beer House, the Esterbrook Beer Garden, and the Greendale Gazebo, just to mention a few. I'm going to switch it up today. Instead of random stories about crazy people with whom we share the planet, our stories today have involved some extra irony baked in. Our first example of irony comes from Phoenix. A short-order cook went to the desert to shoot some giant saguaro cactus. The locals called it plugging. He picked out a 27-footer, and he fired 2 shotgun blasts at it, which caused the cactus to split in half. The largest piece fell on our cook. He won't be doing that long. He won't be doing that again. A 48-year-old health nut decided he was going to unlock the secrets of youth and carrot juice. He drank nothing but carrot juice for 10 days. During that time, he consumed 70 million units of vitamin A. His body turned a bright yellow, and he developed cirrhosis of the liver. Now he's tending to the great carrot patch in the sky. And finally, this ironic story comes back to us from the Civil War. During a skirmish, rebels from the Confederate Army were firing at Union soldiers. Well, the Union soldiers began to scatter, making the Union general angry. He yelled at his men that those rebels couldn't hit an elephant from that distance. And those were his last words. On the podcast today, we have Adam Bailey, Kendall Bauer, Joel Driesing, and wrapping up the week, here's Kyle Teding.
Well, thanks, Max. A decent week overall. The NASDAQ up 1% this week, closing at the bell at 18,120. The S&P 500 up 0.6%. That's 36 points, closing at 57.38. The Dow Jones Industrial Average up 0.6%, closing at 42,313 after adding 138 points on Friday. For the year, NASDAQ up 21.3, the S&P up 21.4, and the Dow Jones Industrial Average up 13.7%, all three including dividends. A quick look at the week on yields. Benchmark 10-year U.S. Treasury just a touch higher, while the 13-week Treasury bill moving a bit lower this week. And so finally seeing some stabilization on the rate front after what had been a lot of action from the Fed last week. Finally seeing some stabilization potentially that offers some maybe sanity from what could be a bit of a volatile stretch for stocks as we enter a new earnings season, election season, plenty on tap. Of course, maybe the biggest piece of news this week, Kendall comes out of China looking at taking a bazooka to stimulus potentially and adding some significant money, although maybe not as significant at second glance, but some significant money to try to get the economy running on all cylinders again.
Yeah, I don't know if I'd say bazooka, although that's been an interesting word to see thrown around in a lot of publications this week in reference to it. I think maybe more Red Ryder BB gun. You look just real quick, look back to the stimulus package they put into effect in 2009 was something around 14 trillion. And this one being a little closer to 1 to 2 trillion. So, certainly Chinese stocks rallying this week on news of stimulus. But I don't know. For me, I think the biggest question is, will we see them follow through with it? So people think, hey, let's rush over there. There's opportunity. You saw a nice rally again in their markets, and other people may say, hey, this may be a good place to potentially throw some money at. And I'm just not so sure that I think it's somewhere where you need to rush into, right? Maybe tiptoeing might be a better analogy.
Yeah, we'll see how this one plans out, but at least the initial vibe is that China's plan, it's made a splash in the global markets this week from Australia to Europe, and it has the potential to pull the second largest economy out of its deflationary funk that it's found itself in. And this has also really been the first admission, I think, from China that they've had an issue, that they've had a problem, because a lot of the numbers out of there you get the sense like they haven't been honest with them, a lot of the economic numbers. And this is more an admission from them, okay, fine, we do have an issue. We are going to make some meaningful steps to address it. And, the first step to fixing a problem is acknowledging it. And that's part of what they did this week.
I think, too, that was a big thing in some of the articles, reading today was rallying more around the language from some of the officials rather than necessarily the stimulus size or the package of what, they plan to actually enact.
Well, and I think it speaks to the Chinese government's willingness to step in, right? That you had an economy going back to pre-trade wars. Trade war added a whole nother layer of complexity to China's economic engine. But pre-trade wars, you had an economy that was clearly slowing as it tried to transition from an economy very much driven by government spend. Yeah, you make a lot of economic advances when you build another highway to another city, when you add a bunch more buildings, a bunch more commercial space, but eventually the benefits of that build-out start to slow, and you need to transition towards an economy that's actually driven by something beyond simply government spending. The Chinese economy clearly going through some bumps along the way and trying to transition towards a more consumer-driven economic engine, much the way our country is, and I think this is simply a function of what's been a long-running issue for the Chinese economy beyond even the immediacy of some of the property issues that are out there, some of the real estate issues that are out there. But I have a bigger concern, and that is that when we look back to some of the low interest rate environments that we were in post-financial crisis, it lent itself to some risk-taking that potentially wasn't for the best of markets more broadly. And part of the goal here with China's economic stimulus is to essentially advocate for risk-taking, to encourage businesses to buy back their own stock, to encourage market players to borrow money to buy stock overall. Those are things in which generally in a healthy economy or an otherwise healthy economy, you're not really angling for. China's certainly not falling apart right now. And so I think, if anything, I'm a little bit nervous about what this means long-term for investors' willingness to take risk, because the alternatives in China, again, buying a piece of real estate that maybe isn't going anywhere for a while, don't seem as attractive, and they're really pushing investors towards areas that they think are needed. I think we have certainly seen a little bit of a bump in the stock market this week, potentially from some of the China news. But I think also as we've continued to see the post wake of the Fed announcement last week, it's been a bit of a calming impact on stocks overall, Adam. I wonder how you're kind of digesting some of the post-Fed announcement news and what you've kind of seen from investors more broadly.
Well, I think post-Fed announcement, there's not much new news until we kick off earnings season. Officially next week, but we won't get to the meat of it really for another 2 or 3 weeks. We've had a host of economic news this week. It's a bit of a mixed bag. Some of it good, some of it okay. But it generally paints a picture of a slow and steady economy. GDP is still solid. Inflation is cooling. Business is profitable. So more or less some decent economic news that we have out this week. And I think a lot of investors are just waiting to really get a confirmation on earnings. And we really kick that earnings season off starting next week.
And Adam, a lot of these economic numbers that came out this week are things that have happened before the Fed took their actions. And they base their actions, as they say, on data. So they we're seeing at least hints of some of these numbers. So, I guess you'd hope that these numbers are lining up with what the Fed expected.
And what I appreciate about that is not only are the numbers that we're reporting this week pre-Fed announcement, but the numbers we're going to be reporting for the next few months really probably don't fully reflect the impact of these Fed cuts, because it takes a while for that impact to be felt across the economy. When you consider, all right, how often am I going to buy a car? How often am I going to buy a house? How often am I going to buy a refrigerator on credit? These are things that ultimately have some of the biggest economic impact. We can talk about this a bit in a second when we look at durable goods, but aviation, right? How often am I going to buy a Boeing 737? Yeah, probably once in my life if I'm lucky. And if I am, I'm probably not putting it on credit. But if I do, it's only going to matter when the day comes to make that purchase. And so I think a lot of the economic news is going to take a while to fully reflect that shift. It's one of the reasons why the Fed had to get so far ahead of the issue.
It takes months. We're just 1 week in to the Federal Reserve lowering interest rates by 0.5%. And one of the things we know pretty clearly from history that it takes at least 12 to 18 months from a Fed action before it really starts to materialize in the economy and you can actually see and feel the effects. And we're a long way away from that. And obviously the economic numbers that we have this week don't reflect that. And to your point, Kyle, probably the ones that we get next month won't either.
And I think it's why it's so important that the Fed has been as clear as they have on language, right? That they've signaled to markets, they've signaled to investors, they've signaled to consumers more broadly, hey, it's probably okay to go spend a little extra right now. You want to build out that factory and borrow a little money to do it, go right ahead. Rates are going to go down, but they're not going to go back to zero, and it's certainly not anytime soon. And so I think that maybe gives managers, it gives executives, it gives consumers broadly a little more confidence to say, all right, we can open up the purse strings a little bit, we can start to spend, because the opportunity is there now to see maybe a little bit cheaper financing down the road. Joel, I think as we maybe get into some of that economic data, a busy week overall, a lot of information in particular on what's been one of the stickier parts of the inflation story in housing.
Yeah, we had a couple of numbers. One is from the S&P CoreLogic Case-Shiller Home Price Index. I always love saying that because it's so concise. But that's showing actually that there's a downward trend in the year-over-year price gains that have been going on. Now, the price gains keep hitting a record. They've done that for 14 months in a row, but the pace of that, of those gains are slowing down. It was a 5% year-to-year gain in July. That's the latest number that we have, but that's down 4 months in a row from 6.5% in February. And we also had numbers on new home sales. There too, actually, they showed that the median price of a new house actually went down about 5% from the year before. And that's largely because the lower price houses are the ones that are selling the most right now. Those are available and those are what's selling. Both of those actually kind of show some promise maybe for the housing industry. We've seen mortgage rates coming down. They were 7.8% a year ago. Now they're closer to 6%. And some of that went down before the Fed made their cut, and it's anticipated it's going to go down more. The National Association of Realtors said this week that they anticipate that that's going to help affordability and that's going to help demand. But the problem with the housing industry has been more the lack of supply. So we're starting to look at those numbers more. And as we've been saying, there are more houses that are being built, that are under construction, that are in the pipeline, but it's still woefully short of what's needed.
And of course, I think some of what might help people feel a little more confident in buying those homes and moving out is lower rates. We're seeing some signs in consumer sentiment and consumer confidence that maybe in some areas or some measures things look a little worse and others things look a little better.
Yeah, so there's actually a number, so the consumer sentiment from the University of Michigan, I was checking this out, and from what I can tell, the questions that they ask consumers were cut off like a week ago today. So that was after the Fed cut. So some of those responses actually might be starting to reflect the Fed cut. And that actually was a more optimistic survey than the one done by the Conference Board, the consumer confidence numbers. That cutoff was September 17th, so right around the time the Fed made that cut. But yeah, so we know that consumers drive 2/3 of the economy, and the more they're optimistic, the better they feel, the giddier they are about going off and buying a Boeing, the more it helps the economy.
Just a brief note on consumer confidence and the consumer sentiment number. I mean, you'd be remiss to think, wait, aren't those like the same thing? They kind of are, but it's actually a shorthand of two separate surveys from different sources. But both consumer sentiment and consumer confidence aim at judging Americans' confidence in their financial status and basically any expectations of how that might change. They're essentially trying to do the same thing, even though we have two different numbers. They're both trying to go to the same goal.
And they have similar questions, and they're trying to get similar answers, as you say, but they come at it from different vantage points, too.
Well, so let's talk Boeing here, and obviously the news on a strike at Boeing with a lot of the manufacturing piece is weighing potentially on U.S. economy, just given the size of a single plane. You know, one less plane produced and sold has a pretty big impact, but we got some numbers on durable goods, August changed from July, that showed, that was a pretty big detractor overall, but otherwise kind of flat in terms of month-over-month growth.
Yeah, it was actually flat. It was the Commerce Department said it was 0.0% change from July to August as far as overall durable goods sales. But part of that was a 7.5% decline in commercial aircraft orders, and that's something that varies so much from month to month that when Commerce reports these numbers, they actually have one number where they say this is the total number, and if you take out all the transportation equipment, mostly commercial aircraft, but also automobiles, this is the other number.
You know, when I first read that the durable good numbers came in as flat, I mean, you would think like, that's not all that good. But when you read through it and you see that there's a 7.5% decline just in aircraft, like two aircraft, you don't buy two 747s. That's $1 billion right there. And even with the huge reduction in commercial aircraft, even still, durable goods was flat. And I think that speaks to some impressive consumer spending elsewhere.
Signs of that, obviously, in the personal spending numbers that came out. We got the final estimate for GDP for the second quarter. Again, I think signs potentially, Joel, that the economy is stable, if not overly strong.
Right. The GDP came in at 3% growth for the second quarter. And that's pretty good. I mean, it's if you look at it on a second quarter compared to second quarter last year, that's 3%, and then the average since 1948 is 3.2%. And let's keep in mind that this is when the Fed has been raising interest rates to try to slow down the economy. So having that kind of production is pretty good.
I'd say. Well, this is probably a good time to remind everyone that we have a seminar next Tuesday, October 1st, out at the Ingleside Hotel. Would love to have you join us. We have a few seats left. Again, on October 9th, the morning of October 9th, out at the Ingleside. Would love to have you join us there as well. If you haven't already gotten the news, if you haven't already signed up, we'd love to have you. Beyond that, we enjoy doing the program for you. We will talk to you next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.